Labor's proposed super tax is really horrible and defies the fundamentals of tax law. In this video we're going to unpack it and why it could impact more Australians than what you think. The best way I could describe it is just like this. Look at this little sapling, not yet fully grown, can't harvest it for timber, can't house animals, not yet fully realised. Compare that to a big tree like this. Fully realised, has some use, has some utility. Labor wants to start taxing this little fella. Labor claims these changes will only impact 0.5% of Australians, but there are broader implications and issues that you need to know about. Now, I've also got a question from a viewer on making super contributions on behalf of their partner, so I'll talk about that at the end of the video. Now, keep in mind, I'm not a licensed financial advisor. This video is for entertainment and education purposes only. This is how the super tax works. Let's say this chap has $100 of wages, excluding super. He'll be taxed on $100, so he won't receive all of that in the hand, but that all happens at this level. Super, generally speaking, is calculated on top of the wages. So the super that is owed on this $100 balance is $11.50, and it's that amount which gets sent to the super fund. Now, as it gets sent to the super fund, it hits what I call the superannuation wall. Now, this is the first taxing point. 15% tax applied on the contributions to the super fund. Once it enters the super fund, he now has a little pot of gold there, and that pot of gold will be invested to earn dividends, interest and capital gains. Now, he'll be taxed on those profits at a rate of 15%. Now, importantly, he'll not be taxed on this pot of gold itself. He'll be taxed on the profits that this pot of gold produces to the rate of 15%. Now, what Labor wants to change on balances over $3 million is how those profits are taxed. For dividends, interest and capital gains, instead of 15% tax, they want to tax it at 30%, and they also want to include in the calculation something called unrealised gains. Now, tax law generally follows a cash basis for taxing. You receive wages in the hand, you get taxed. You receive a dividend from your investments in the hand, you get taxed. You sell your investments and realise a profit, cash in hand, you get the picture, you get taxed. By taxing unrealised gains, what this means is if you have shares or if you have investment properties in your super fund or in a self-managed super fund, if those items go up in value, you'll be taxed on the gain or the paper gain for those assets, even if you don't have the cash. So what that will mean is that you either, if you don't have the cash, you either have to borrow the cash or you have to sell some of the assets to be able to pay the tax on those items. Really horrible, really silly, which is why it's not very common in tax law. This measure, the government's trying to raise funds, that's all they're doing. Now, I'll tell you why younger Australians should also care about this a little bit later. And for people that just have regular superannuation funds, maybe this won't be such of a big impact. There could be cash within the fund elsewhere that could possibly pay the tax and then some sort of lending system. But this will heavily impact self-managed super funds, which tend to be very asset heavy, holding things like land, the family farm, those sorts of things. They don't necessarily have excess cash lying around to pay these taxes, so they're going to be really impacted by this measure. And although this measure is targeting richer Australians, unfortunately around 2/3 of retirees don't have enough superannuation to retire. I mean, they rely on the age pension. And with an aging population, these numbers are just predicted to increase. So for me, it doesn't really make sense to tax people that have been fortunate and do have enough money in their superannuation, those people who are less reliant on the government, taxing those people and making their position worse. It doesn't seem logical to me. Now, this is why you should care even if you're not close to your retirement. One of the poorer functions in our tax system and one of the poorer functions around this announcement is that it is not indexed to inflation. Now, what that means in our personal tax system is we have income tax rates at different levels, and those rates do not increase each year with inflation. Inflation occurs every year, so as your income rises due to inflation, you get pushed up into higher tax brackets without really necessarily having extra buying power because your money has been subject to inflation. This measure as well, the 3 million cap, is not subject to indexing, which means it won't impact people maybe 1 year, 2 years, or even 5 years. But future generations with their superannuation payments being subject to inflation means that more and more people will be pushed into this measure. So it will impact more Australians than what they're initially predicting. So what can you do? This law has not yet passed. It lapsed, due to the election and will be reintroduced into Parliament shortly. So if you're really passionate about this, we need some advocacy. You should really speak to your local member expressing your concerns around this. If you found this video helpful, we'd really appreciate it if you punched the like button. Helps push my video out to other viewers. And please leave me a comment below. I'd love to know what you think about this legislation, about this bill. Now to the question from one of my viewers on superannuation contributions to your spouse. Now keep in mind, superannuation is a very, very difficult area of tax law. I would definitely recommend going and seeking the help of a professional before you do anything with regards to your superannuation. But now we'll talk about some general concepts. So generally speaking, females have a 25% lower superannuation balance when they retire than their male counterparts. And that's typically because females have taken on the primary responsibility for caring for children and don't receive super contributions during that period. So if you have a discussion with your partner and you think that perhaps it might be beneficial to make contributions to your spouse's super account, so it's more of a level playing field, then there are two methods available for you to do this. The first is called superannuation splitting, and the second is called superannuation direct contribution. Let's first talk about superannuation splitting. There are not necessarily tax advantages to this. There are other sorts of advantages possibly for doing this. So the superannuation contributions your employer makes on your behalf, as well as any tax deductible superannuation contributions you make to your fund, you can simply fill in an application with the tax office or with your super fund and elect for a portion of those to be rolled over to your spouse. So because you've already received the tax benefit, there's not necessarily an additional tax benefit to doing that. It's more like leveling the playing field. One potential benefit though is if your spouse is older than you and will reach retirement before you then can access some of those funds sooner. You generally have to wait until the financial year has finished before you can submit your application. The second is a direct contribution to your spouse's super account. Now, in this scenario, you may be eligible for a tax offset. Now, tax offsets are not as good as tax deductions, so you won't get whatever you contribute, you won't get the full value of that in a tax benefit. It'll be much smaller. And you're only often entitled to that tax offset if your spouse is a low income earner. There's a great summary on the ATO website. I'll leave a link in the description that goes through the eligibility criteria. But again, make sure you seek professional advice so you're not breaching any caps and that you're following all the laws properly. Hope that answers your question. Thanks for joining, guys. I'll see you in the next video.